Well, welcome everybody to the March edition of the Roundtable. I'm joined here by my friends Ken Kavula, Cy Lynch, Hugh McManus, and yes, we still have Hugh. He's lingering and continuing to celebrate St. Patrick's Day past in his attire today on the cover page. And my name is Mark Robertson. And we did put a little tribute to Mega Millions on the cover page of the session today for all the things we were just talking about. You know, one, I was amazed by the amount of attention that Forbes, the magazine, paid to the lottery situation yesterday. And as we made the point a few minutes ago, you're here today because you either lost the lottery yesterday or won. And one of those two things is true. One of the things we do like to point out at this stage in the program is that if you know somebody or if you yourself wants to be notified of future programs, you obviously can access the program through several different ways, but if you want to be added to the mailing list, Ken Kavula's email address is in this link at the bottom. And again, feel free to share that with others who may be interested in getting notices on attending future sessions, but we look forward to doing that. All right, let's go ahead and kick into, well, first of all, keep the legal department happy. This session is an educational session. Everything we do here is for illustrative purposes, and it's particularly true for today's session when we'll be talking about real companies in real time, expressing opinions. You shouldn't run out and buy based on the opinions that you hear expressed, and no investment recommendation is intended. In the spirit of many things that we do both at Manifest Investing and at our host chapter here for Better Investing, the Mid-Michigan chapter, we do a lot by demonstration, by exploring together, and that's what this is all about. Keep that in mind, and please, please, please do your own homework. All right, I thought we might shuffle things up a little bit here today. For those of you that are new, extra big welcome to you. Those of you that have come to other previous sessions, we've been doing this now for a couple of years. I'll kick things off with a brief introduction, and then we're going to shuffle things a little bit and kind of sprinkle the stock discussions on the individual companies throughout the session, just kind of bounce around, and we encourage people both in the audience and all four attending nights, and we actually do have one of our guest damsels in the audience. Ann Manning is here also this morning, and encourage anybody who has comments to either raise your hand or enter a question or a comment using your questions tab on your management panel. Just as a quick reminder, we have been doing this for a couple of years now. We try to get together once a month. We try to pick investments that improve our probability or the chances that we can generate a long-term return that is 5 percentage points, 500 basis points, better than the Wilshire 5000. So we benchmark against the Wilshire 5000. Then we would also like to see basically 60 to 70% of the selections that we make outperform that benchmark, and as we compare them over like periods of time. How are we doing so far? Well, this is the point in the program where I generally like to be quiet. Most of the people here, with one notable exception, actually are operating somewhere pretty close to a zero relative return. In fact, Mr. Kavula, in fact, he gets to lead off because he has actually bumped into a positive relative return for the selections that he's made over the lifetime of the contest. We're not deterred. I mean, eventually I will, I'll start listening to Ann more closely, or I'll figure out a good idea for some future selections. But collectively, we have been improving. Keep in mind that we were at a -8 relative return about a year ago. So we're definitely making progress towards target. Our accuracy has improved lately to greater than 50%. That also was less than 40% in recent months. So we're undeterred, and we continue to march forward as good knights would. And thanks to all my fellow knights for not picking on me too much there. Thought we'd share one picture here that kind of puts the. Again, we talk a lot about context when we talk about long-term investing. Kind of puts our current situation in a little bit of context. And what you're looking at here is a picture of the Wilshire 5000, that index as measured by the Vanguard Index Fund. VTSMX is the ticker. But you see the stock price bars, or the fund index price bars, from left to right. And you can see somewhat of the flat decade, although as the blue trend line points out, there is a little bit of left to right movement up. And as everybody knows, we set a new multi-year high again just this past week. In fact, closed at a high yesterday. Superimposed on that is if you had taken the value line investment survey and graphed the average or median low total return for all the companies in the guide. And again, when we explain this, we basically say high is good. High is, higher projected returns means higher forecast levels. Back during the depths of the bear market and the Great Recession, the returns on stocks were up in the 20 to, in some cases, 30% range. That was the time to back up the truck. This period here was not as favorable a time. The forecasts were actually lower, so it was a time perhaps to be a little bit more careful as we approached this peak. So again, where are we today? Well, frankly, we're somewhere pretty close to the middle of that long-term trend. If you look at just the red forecast line, somewhere in that 7 to 8% range means that we're pretty much in the middle, perhaps shadowing the lower side of the middle of that range from a long-term perspective. And I would invite our fellow knights, how do you look at this, and how does it actually change, or would it have any influence on investing decisions that you make?
Well, Mark, I'm viewing it from the point of view that in order to begin to have some real problems with the market, we'd have to begin to approach those historic lows that were down in the 5% or even below 5%. I'm feeling not super confident, but I'm feeling that as long as the returns stay somewhere, around 8, 9, 10, 11%, that there's probably room for the market to continue to expand.
Yeah. How about either?
I agree with Ken on the overall outlook. And as for impact on my investment decisions, with the low return forecast, as you say, in the middle, maybe the lower end of the middle with MyPar below 8%, I do accent financial strength and perhaps stability a little bit more than I would if those were both double-digit things. So I'm tightening my quality a little bit as a result of being in the middle range. And I also recognize it's not on this chart, but an indicator that I also watch is the VTSMX par, the par for the total market as a whole, which right now I think is running right around 10 or 11%, and compare it to to MyPar, and when that is above MyPar, that is showing me that there's more shopping in the larger, more blue chip type companies. So again, I'm steering a little bit towards safety right now, just to prepare for a potential downturn.
Yeah, and Hugh, I guess I've noticed you've kind of been leaning towards the larger companies, the Staples, the Costco's. Is that any way influenced by any of this?
Not really. I mean, I generally don't look at the global outlook too closely when picking a company. I tend to be very company-centric. I might look at things like, well, I look at revisions of GDP and of average household income to see how those are panning out. They've shown recently the recovery is a lot stronger than was initially anticipated. But I tend to look at individual companies more than the forest, if you will. Yeah, would that influence you though to shop more in the retail side of things, your Staples, for example, and things like that? Well, it would, and the other thing I'm waiting to happen is for the brokerage houses to start bouncing back again, which ultimately will happen. They've been languishing, a lot of the financial sector. Sure. All right. As people get more money, things will improve, Sure. Well, let's go ahead and move on. Let's go ahead and go to our first stock presentation. In fact, Ken, I think we need to switch the screen back to you.
Ken has selected IPC, the Hospitalist company, for this month's session. Okay, you should have the screen, Ken.
I want to tell a little bit of a story about IPC before I actually go into my presentation. Let me make sure I get the first slide up here. Here we go. I first was exposed to this company over a year ago by a member of my investment club. She's been a long-time member, and I really respect her stock analysis abilities. And her husband was the administrator of a very large hospital system just north of us up in the Saginaw Bay City area. And so I also respect when he comes up with a company name that he has some direct experience with. And the company they brought to the table was this IPC. It's called IPC, the Hospitalist company. That's the official title of the name of the company, and its ticker is IPCM. But I became intrigued because, first of all, I wasn't quite sure what a hospitalist was, and second of all, I had never ever studied a company that was doing what IPC was doing. Just last Saturday, to continue the story, we had a large event up in mid-Michigan, and one of the activities at our event was the presentation of 5 stocks and then the use of the stock comparison guide to come up with what we thought was the best of the breed in the industry that IPC happens to be in. And in fact, IPC was one of the stocks that was presented. And then after the entire room worked on the stock comparison guide, IPCM was the company that was chosen as best of breed. Some of the other companies that we compared it to, they weren't direct competitors by any means, but we looked at U.S. Physical Therapy, for example, and Universal Health Systems, and they sit in the same general industry of offering services to patients through hospital or through surgical centers. So with all that in mind, I decided to do a little bit more work on IPC itself. And you've had a chance now to read the company's definition. All of these beautiful slides were not prepared by me. These were prepared by the company. I found these on the company's website. There's a quite complete presentation there that if this company interests you, you might want to take the time to go and take a look at the whole presentation. I pulled out 8 or 9 slides that I thought were particularly appropriate for what I was going to talk about. But you can see where the company is coming down, and IPC is in fact the largest pure play hospitalist provider. 2 of the competing companies, one of them is called Team Power, and it is a publicly traded company, and the other company is called M-Care, E-M Care, and it's not a publicly traded company. So there is some competition in the niche, but it's a widely fragmented niche, and even the largest player is a relatively small company. I'm looking to how many hospitalists IPC has, and I was pleasantly surprised that there were over 1,000 of these people employed by IPC. In fact, at the end of the fiscal year in September of 2011, that number looks like 1,132, and it appears that the turnover rate is relatively stable. They're carrying about a 15% turnover rate in these positions right here. They are widely dispersed throughout the country. You can see that where they have their facilities, and a single facility will many times serve a large number of hospitals. There's a big orange dot in southeastern Michigan, for example, and that serves hospitals up into the Flint area and a number of hospitals in the Detroit area. In fact, the local hospital that we use does contract with IPC to provide hospitalists for its facility. They're centered in Los Angeles. That's that big red dot over on the west coast right there. And you can see that the only place where they don't have a real presence right now might be in Appalachia and in the Old West or the far west going up into the Northwest. The number of hospitalists, this is a relatively new discipline for doctors. It started in the mid-90s. The whole concept began. And today, the Society of Hospital Medicine estimates there are about 30,000 hospitalists in hospitals and ambulatory centers throughout the country. Well, if you'll remember, IPC has about 1,100 of those, so you can see the fragmentation in the industry. Here's what a hospitalist actually does. In fact, when my mom was in the hospital and had to stay there for a long period of time, we worked with a hospitalist. So I found out that I had direct experience with this type of a doctor and wasn't even aware of the fact that I was working with a hospitalist. Basically, they take the role of the patient's advocate in the hospital. They manage their medication. They visit them on a daily basis. They're the people that keep in constant touch with the primary care physician, with the hospital staff, with any specialists that might be assigned to the patient. They also keep in touch with whoever is going to be paying, that's the insurance providers. They're the ones that the family members would have a contact to talk to on a regular basis. And the hospitalist will even follow the patient if they would be assigned to a rehabilitation unit or something like that, for example. So that they really take advantage of it. We had a large discussion at our last investment club. In fact, my club ended up purchasing some of this stock. And the discussion centered around the fact that many of us knew doctors that had gotten disenchanted with the whole business aspect of medicine and wanted merely to practice medicine. And the role of the hospitalist was to try to make that an easy thing for specialists and for primary caregivers to do without having to get involved with the institutions that their patients get involved with. IPC has a lot of people that it keeps in constant touch with, but it likes to make the point repeatedly that the most important contact that it makes is with the patient. They're the patient advocate for whatever setting the patient finds himself in. IPC works with all of the people in all of the boxes on this slide. They like to put in their literature that they have a 98% patient satisfaction rating, and these 1,100 or so IPC hospitalists are getting referrals from over 37,000 physicians at almost 800 facilities throughout the country. There's the advantages of IPC, and again, this presentation in a long form is available at the IPC website under Investor Relations. If you go there, you can download this presentation and read it at your leisure. I think this is maybe the last slide. IPC also is very advanced when it comes to collecting the data from its hospitalists and then aggregating that data and making sure that they're using best practices to deal with patients as they learn more and more about how to deal with patients in different settings. The data is being collected and then being fed back to improve the service. oh, I do have one more slide here, how they actually get paid. A lot of the companies that I study in the medical field have a dependence on Medicare, Medicaid payments. You can see that the Hospitalist only gets about 50% of its payments from Medicare, Medicaid. 6% of its total revenues come from contracting with the hospitals as a whole. 94% comes from the pie chart right there. And they view it as a relatively stable revenue stream coming in the percentages that are indicated. I'm going to move real quickly to an SSG. And I'm going to move there if I can pull one up, that is. Well, how do you like that? Let's see what I can...
Oh, even my SSGs look better than that.
They do.
Where's the earnings, Ken?
There's no SSG, but let me close this down and then open up my toolkit again.
One thing I might point out while Ken is tinkering around with that, we did feature the Hospitalist company at Manifest Investing back in October 2011 as our cover stock, and
that's right.
it's kind of fun to see the background behind it and how this all kind of took shape.
Here we are with the lines. Actually, the company's only been public for the last 4 years, so I would feel no compunction about going in and examining only the last 4 years. And you know, when I'm looking at a company that I don't know very much about, when I can see lines that look like that, especially on a relatively small company, I'm quite content. Mark gives it a very high quality rating. I'm going to turn this over real quickly because I don't want you to copy my SSG. What I'd rather have you do is do your own SSG. I see profit margins that for the last 4 years have steadily moved in the right direction, and I see return on equity that I consider acceptable for this industry. I like to see return on equity over 15% at just over 16. That's a really nice thing. I'm going to scroll all the way to the bottom where I'm getting a return of about 18%, a par of about 18%. And I'll show you the Manifest screen for IPC as well. Manifest gives this company an extremely high quality rating of 85. Mark's par is a point off of my par, and I think that we're basically singing the same song when we look at those numbers. I examine the numbers that Mark deals with, and I tend to agree with them pretty closely. I'm looking at the quality components, and I agree that the profit margins are a little bit above average, but that the rest of the numbers, including sales growth, earning stability, and financial strength, are just outstanding for the company. I really like it as an idea. It is a smaller company, so I urge you to do all of your homework. There is no value line that at least people are used to taking a look at. Let me get the right tool here. Well, I can just click there. All that you'll see in value line is a small and mid-cap value line, so you don't get any real analyst estimates going forward. But I certainly think it's interesting enough to do a study on, compare it to a couple of other companies, and draw your own conclusions from.
Okay, thanks.
Yeah, I like the fact that people on Motley Fool really haven't focused on this company either.
Yeah, except that the ones that have all like it.
Yeah, they do, but there's only about 16 of them.
Yeah.
Yeah, this is the kind of small company that I really like to find.
Yeah.
I like to find it before it's really discussed by a lot of people, and that's where Quality Systems was when I discovered it. That's where a couple of other of my big winners were when I stumbled on them.
Cool. Well, I'll go ahead and switch the screen back to me.
Great.
Thanks, Ken. I do think it's a worthy study. One of the things I would point out on the cover slide here is I've gone ahead in our tradition at Manifest and embedded a couple years of analyst estimates, both the revenue side and the earnings side for the company, and they certainly seem to be in order, or at least relatively consistent with the long-term trend. So it's like a pretty interesting company to take a look at.
Absolutely.
Well, I was in the mood to celebrate a little bit and also get grounded a little bit here today, and so what I thought I would do is share some of the stuff that we can celebrate. And what I've done is taken some of the actual individual transactions. Companies can be selected more than once and rank them by their relative return. So we high-five around the water cooler that Ken brought Apple to the group back in May 2011, which is almost a year old now. And you can see that his relative return in that slightly less than 1 year period is 74%. And basically what I've given here is the top 16. One of the things that I find most comforting about this chart is that my name is on it.
Yeah, how did that happen?
I don't know. There's three where I just basically got out of control. Maybe you whispered Roche, that one down towards the fifth from the bottom, but pretty good distribution of contribution, including 2 selections from Ann Manning, who's here in the audience.
Wow.
That made the list. And some pretty good activity in the Bank of America world there. Hugh has actually shot up the list with that selection of Bank of America. But keep your attention on that one as I turn to the one, and I thought we might just have some playful banter or whatever works here. These are the ones that haven't worked out quite so well. And I didn't want to find my name on this list, and I certainly didn't want to find it as often, and certainly not in that bottom position. So I do my best to try to learn from those experiences. I will confess that my selection of Research in Motion was influenced by being too close to it, and let me explain. We definitely disclosed it at the time as a falling knife and a company that might be in trouble. If you go back, you can actually read the transcript, and we definitely actually had the highway sign with the falling knife and all that stuff, all that good stuff. But what was I clouded by being too close to it? I mean, I actually know people who work directly with the 2 founders of that company, and by the way, both of them either resigned or were fired within the last couple of weeks. Not
now in your basement.
Story. Yeah, and you know, anything you read about this company, it's trading below book value. It's too late to sell it, but I don't think we need to do it now, because I think we want to kind of march towards the question and answer period where we perhaps want to talk about things like Apple and other things. But one of the things I want to toss out there, I've tossed it out a few times, I'm going to keep tossing it out until it either doesn't have, I decide it doesn't have merit, or it does, and that is, when it comes to selling a stock in a situation like this, like I'm not a great fan of just hard stop losses like Bill O'Neill and his, when it's down 8%, you just dump it and run. But in the case of a company like RIM, maybe at the point where it hit a -20 relative return or something like that. And I think that's something we could talk about in the future. Is there some type of a relative return trigger on because we admitted when we picked it, it was speculative. It had one of the elevated return forecasts. So again, I just open the floor for comments, and anybody else that wants to bash some Chinese pork and get me off the hook here.
Well, here's a question. The late, great Walter Schloss, there's been some very nice obituaries written about him recently. But I wonder what, if any of the companies on this list here, he would have been sniffing around. Yeah, granted, some of them are technology and maybe outside of his comfort zone. But sometimes it's worthwhile paying attention to beaten up companies just to dig in there.
Absolutely.
To see if there's value that hasn't been recognized. Hogs, for example, I've been tempted to go pick that one.
Which one here did you say?
Well, Hogs and RIM as well. Who knows if RIM is really knocked out,
Well, there's another part to the story, and I'm probably beating side of the punch, is it's early, folks. There's a patience element here, too. I mean, look at those 3 Bank of Americas right in the middle of the pack there.
Yeah, that's right.
Exactly. I was about to jump in and say exactly that, Mark. You did beat me to the punch. If you are especially a situation where you know you are going against the trend, be it a potential falling knife, be it just a very beaten up sector. RIM certainly falls in the falling knife category. Bank of America, and I notice one of my picks that I wasn't aware I was going to get the leaderboard here, thank goodness for Mark and Chinese Port to keep me from the bottom. But I knew that First Niagara had not been doing particularly well. But again, I think, but those are banks and so forth, which again, I think they're early in the recovery. And Hugh acknowledged right up front what he was doing with Bank of America, and I did the same with First Niagara. And I would be wary of setting a relative return thing for a stock certainly like that. Now maybe one that the company itself is having problems and you're betting on a turnaround or something, possibly a RIM might fit that a little bit better. I don't know, but certainly an industry problem or a more macro problem than company specific, I'd be real wary of saying, gee, I'm going into this knowing I'm going against the headwinds and going against the rhinos, and yet I'm going to sell out based on the rhinos beating me up. I mean, that doesn't make any sense.
Good point.
Mark, we're getting a question of how can Bank of America appear on both lists, and the speculation is that it's different time frames, and I think that we can verify, in fact, it is different time frames. It was chosen a number of different times, and depending on when it was chosen dictates what its relative return is going to be.
So, yeah, look here, just a couple of months ago at our stock price just above 7 versus a couple of selections towards the end of last year. Oh, well, actually 2 years ago now, when it was actually in double-digit prices.
And the interesting thing about Bank of America, too, is, of course, I wasn't too nervous about it back then, but now everyone's starting to say nice things about it, so I'm getting a bit leery.
Well,
and the other point is, that hits me is RIM on the bottom of the list and Apple on the top. Now, they're not exactly competing in the same market, but there's an awful lot of overlap there. And it kind of reminds me of the issue with technology companies. I mean, I like to say that McDonald's is a company sitting out on the plane. It can look at the horizon and see the competitor, the dust from the competitor for miles and miles and miles away, whereas technology companies are really in the jungle, and you can step around a tree and get bitten. And then the life cycle of technology is so fast that it's often faster than the reporting period, which is quarter to quarter. So it's often more challenging to see trends in technology companies, at least as reflected in the financial statements, as compared to the old faithful companies like, actually, the Banks of America, the Aflacs of the world, it's the Abbotts, etc., where you've got moving averages for many, many quarters that begin to reveal trends.
All good points, and I would point out that you can even see it in the analyst forecasts for a company like Apple. They have no idea how to keep up with that beast.
Yeah,
they're just having a really hard time, and the opposite is true in the absolute flip side of the coin, bad way, with RIM. I mean, the world is clearly ending at RIM, and I have a feeling it probably isn't.
I don't think it is either.
I hope not either, because if I end up with a minus 100 there, you guys will never let me live that down. All right, let's go ahead and switch to the next one. It's Hugh, and he's decided we've actually picked Walgreen on 5 previous occasions, and he apparently believes that people still want to buy drugs.
Yeah, I'm still optimistic that people will buy drugs. I love the way you put 2 years into the future there. Yeah, sales are going to slow down. I think everyone agrees with the loss of Express Scripts. Every report I've read says that sales will be dropping, or at least leveling off. And actually, when you dig into the numbers at Walgreen and you look at the impact that Express Scripts has not only on the top line but on the bottom line as well, I was initially quite worried last year that the revenues were going to be quite devastated, but apparently not. I mean, this is good news. And Walgreen might languish for another 2 or 3 years as they slowly recover from the loss of their partner. So there could be even better buying opportunities in the future. And if you pointed out, Mark, that I was in Europe at the headquarters all of this week and just got back last night, so I didn't get as much time to dig in and prepare slides as I have done in the past. But at least the good thing here is that nothing much has changed from when I looked at Walgreen before, which was in December. At least we now have more published numbers to dictate that what happened in the last calendar year was not as bad as many would have predicted.
Yeah, your slides are here if you want to walk them through.
Yeah, we can go. That'd be great. So it's the leading drugstore chain in the U.S. It has 8,000 outlets. It's actually been growing at a reasonable clip. I think last year it added over 250 stores, which actually is a slowdown from what it's done in the past. But the company actually has taken a position of focusing on the strategy within a store, and we talked about that in December, how they were guzzying them up and making them look pretty, etc., versus just willy-nilly expansion. It's a big company. I mean, it holds about, I think, 20% of prescriptions in the U.S., almost $1 billion a year. There is growth there, obviously, but when you're holding 20% of anything, growth is going to be harder to get, and you're going to have to rip it away from your competitors. But of course, the baby boomers will help. That's the bolus of people who are moving well into retirement age at this point, and into the point where they will be going to Walgreens pretty frequently to fill prescriptions. And to complement what they've been doing, and that is to talk about their strategy, they've been moving into the grocery space as well, as have many other people like Sam's and Walmart, etc., Target even. And I was reading in one of the reports that the stores that do have groceries in them are generating revenues of about 14 million per year, which is a pretty heady number. I want to dig in and look at it per 100 square feet or whatever the metric now is for grocery stores to see how they compare with the Save-Ons of the world or the Albertsons, etc. But it seemed like an impressive number to me. And I was in a Walgreens recently, and you know, I think based on the prices, they're making quite nice profits on what they're doing. We are very close, just the second bullet point, to the 52-week low. I mean, it has gone from 30 up to about 47 and change in the last 52 weeks. We're now close to 32 or 33, so we're near the bottom. But as I said, the last report the company had indicated to me that the financials weren't as bad as I thought they were going to be. They're not really getting hit as badly by Express Scripts as I had kind of secretly feared, even though they're in line with what the company projected, the high end at least anyway. So it has been managed well. I did not update that bullet point. I said 199, but when I checked, it was now up to 150. So I still think this company has a very good future, and I think it's undervalued, and I'm gratified to see that more and more of the people who get paid to say the things that we say here are beginning to say that Walgreen is a buy. So let's move on to the next slide, which should just show the what I've put into the SSG. I had a sales growth level of 11%, and I'm going to stick with that, a bit higher than what most people would go for. I'm leaving expenses exactly where they were when I did the SSG before, back in December. But the growth rate is now a little bit higher than it was in December, at least the implied growth rate based on the SSG, the implied growth rate of the bottom line. And analysts now estimate that the earnings per share in 5 years from now will be 4.66 versus 4.08. So they've been pushing the numbers up as well, based upon what's happening recently.
Oh, did we lose you, Hugh?
No, I'm here.
Okay.
It's the SSG without the analysts' embedded estimates. And it's pretty, I would say. It's not beautiful. There's a few dents there in the Great Recession, but everyone got whacked during that time. But it's slowly on the path to recovery, dented a little bit by what's happening with Express Scripts. It has its own pharmaceutical benefit manager, WHP Health Services, or Health Initiatives, excuse me. And they really focus on a slightly different market share, the small to medium-sized HMOs. But I would imagine that that's the area where we're going to see more growth as the economy starts to recover.
And Hugh, if you don't mind, I just want to show something here that's a little bit of a teachable moment. It's something that we explored with the local chapter here over the last year or so. You know, and you're basically saying 11% down here for your sales growth estimate, and that's coming from, it looks like the most recent year. And
yes.
So your 11% is from down there. Well, when you take a look at Manifest, we always go off of this trend line here.
Uh-huh.
So in the case of Manifest, we could be at, let's just pick a number out of the blue, just say 8%.
Right.
Our 8%, because of the gymnastics of this form, our 8% could deliver the same result as your 11%. And
That's true.
I don't want to go any deeper into it other than to say that is why you see some of the distortions that get kicked around. And I just ask somebody in the audience to remind me to talk about that in greater detail. Sometimes 8% equals 11%, and it just gives us a headache.
And I'll just throw out, since you raised that, Mark, that be even more careful when you take a look at something we don't even mention at Manifest, that being the blue line on growth, that being earnings per share, because that's an even more volatile where is the starting point. So anyway, I mean, you're correct that it doesn't matter whether it's sales or earnings. If you get into growth rates, you can get confused, but a lot of times people will scratch their heads with earnings growth rates, and we're actually getting to the same final number, which is the one out there on the right-hand side of the graph.
Yeah, and every time I hear you talk about that, we talk about the times when Cy, you, and Ken will end up at the same point, but with different assumptions along the way, and I think you see much of that in SSG-based studies.
Absolutely.
Go ahead, Hugh.
Yeah, and the company has, at least recently, relatively strong both return on equity and gross margin numbers. It's looking pretty nice. I should say, too, that on the grocery side, maybe not so much the prescription side, but the grocery and related items side, as the economy recovers, you would expect to see an increase there, and I'm not too sure to what extent that is embedded in the analysts' forecast of where revenues are. There must be something that's in there, but I have been a little bit more aggressive. One more point, too, if you look at the debt-to-equity ratio here, the last number I calculated was about 0.18, but it's just so you know, it is the lowest in the industry, which is very gratifying, and usually that signals a leader. To me, there's a couple of points that signal a leader company in an industry. You generally see the highest profit margin, the best return on equity, the best debt-to-equity ratio. The PE ratio tends to be a little bit higher than most, but those are usually signals that you're looking at a leader. And if we skip to the next slide, we can see the price-earnings ratio. Of course, it took a bit of a nosedive when the Great Recession hit, but it's now back to where it should be. 10 at the low end and 16 at the high end. And I'm now using a slightly lower projection for the high PE than I did in December. I bumped it down, I think, from 17 to 16. So on the next slide, then, you'll see what things look like. And actually, the upside-downside ratio has improved. It was 4-point change to 1 before, but now it's bounced up to 5.5, and that's even with a slightly lower high PE. My high PE actually is now 15, not 16. It was 16. I've cut it back a little bit. And I think I'm pretty conservative on the estimated low price of 26. But, yeah, if Express Scripts, if that issue isn't resolved as nicely as it appears to be, then there is downside here. But things seem to be just fine. I think the next slide shows the MI page from Manifest Investing from yesterday. The one after that shows from December, but we can focus on this one because it just shows, I think, a company that may not be as stellar as the one that we saw for that Ken presented, but for a big guy, it looks pretty good to me. It has a lot of people in Motley Fool following it, but I think its profit margins and sales growth into the future look pretty promising. And I think there's substantially more upside here with Walgreen than there is downside. And those are the numbers, I think, from December, where I think par was slightly higher, but the price was just a smidgen lower, if I'm not mistaken.
Yeah, that would suggest that the analysts are becoming a little bit increasingly concerned about the Express Scripts' impact on growth and perhaps even profitability, I would think.
Yeah. Well, I think it's going to last for another 2 years, so I think there will be chances to buy Walgreen on the cheap for the next 2 years or so. And who actually knows what the healthcare changes in the healthcare legislation are going to, how they're going to impact companies like. Well,
we're counting on you. You're a part-time lobbyist, right? Not exactly.
No, I like to look at the small guys, and it's not really proper to talk too much about those in forums such as this. Well, you do pick up some very interesting information.
Well,
If we have time at the end, I'll share what I learned about Vertex.
oh, excellent. Well,
And I'll
we'll make
leave
time.
that there as a teaser.
In that-
Clinical trials in Vertex.
In that case, I'll cut mine down to 15 seconds. I want to hear that story. All right, thanks. All right, before we jump to Cy, I wanted to just, again, just take a quick snapshot of what, the condition of the portfolio today. In pretty good shape with projected return of roughly 14%, relatively high quality. You can see that and the growth is pretty solid also at 11%. So again, something we've told you over the months. We do not emphasize. We don't sit down and say, Cy, you take a small company, I'll take a large company this month. The four of us basically just go where we see the opportunities, pardon the pun, but manifesting themselves. And if you do that, I really think as long as you shop in the broader spectrum, you'll be pretty much okay when it comes to this, and you'll be pretty much okay when it comes to the pie chart that you see here. Now, with the four of us, it's probably fairly easy to see how we would end up with, because we're not afraid to access the opportunities in technology and healthcare, and those are still not overpowering the portfolio. If you think that either one of those positions is overpowering the portfolio, I would urge you to read Cy's cover story from last month where he talked about there really is not too much historically, especially when the pars that are in that sector support holding those positions. The link to access the roundtable dashboard at any time is at the top. Here's a look at it from just the top holdings in the tracking portfolio, just for record-keeping purposes. Again, we make this presentation available to everybody in the Manifest Forum after the session. And then, as we always do, this next sort is by par descending. So the more speculative opportunities are up at the top, and most of those belong to me. And I'm learning. Probably went a little bit early on some of those. But I think this year my resolution is going to be to shop more in the middle of this page. Any comments, guys, on any of these?
Just keep that slide in mind for a moment. When we get to mine, we'll bounce back to it. But
okay.
That's all I'll say right this second.
All right. Well, Cy, why don't you go ahead and take it away then?
All right. I'm going to be very simple and short today. For one reason, I'm presenting, I think this is the 5th time we will have picked Cognizant technology, so we've certainly talked a lot about it, and I also just want to use it as a teaching point that investing really can be simple, and you don't have to go digging around a lot, particularly with a company in your own portfolio that you already are comfortable with, and that being Cognizant. And so you just jump back to the slide, and this is how I picked Cognizant this month. I took a look at the dashboard, I sorted it by par, and I ran down, just down that column, said home, away, small company, somewhat speculative. I'm not looking too much at that. I actually did use RIM as a motivator and said that I wanted RIM's charts flipped upside down. So I skipped past RIM. I couldn't resist that, Mark. Figured I had to get that in.
Duly noted.
Jean Penn, again, speculative, and we all know a good bit of what's going on there. Plus, while I didn't dig into it, there was apparently a potential takeover or going private discussion or offer this week by some insiders, and to the extent, I think it bounced up to about 13 or so at one point based on that. So the market must now not be particularly believing it's real credible. But again, when you have those sorts of things going, there's certainly a potential near-term ceiling, if not a permanent ceiling, on the price. So I wouldn't necessarily be selling Jean Penn, but I don't know that I'd be looking to buy it at this point. So I just was going through that sort of a process and pretty much got down into the Infosys our Emphasis, Oracle, BioReference, and Cognizant block. Those are all solid companies. Their PARs are all in the same general area as you can see. They're all very high quality companies, which remember earlier I'm kind of stressing both the quality as well as you can jump over a couple of columns there. There you go, Mark, the financial strength. And out of all of that, you see Cognizant has the second best financial strength. It's the highest quality, and really what broke the tie for me was its growth rate of 21%. So that's how I chose Cognizant Technology. I think while we have certainly vetted it in the past, it's still prudent anytime you take a look at a company to make sure nothing's changed. So you can jump to the next slide again, Mark. And you see here that the 20% or 21% growth rate is certainly not unreasonable given history. And this particular chart does have the analyst projections for 2012 and 2013, and you can see that they do not see anything alarming going on with the company going ahead. They're looking at 21.4% growth over the next couple of years with solid earnings going along as well. So Cognizant Technology is my pick. Notice Value Line does have it a little on the low side at 10% for the low potential return. But if you actually look at the Value Line numbers, the growth and the profitability numbers, Value Line seems to be in line with what Manifest and basically my own personal Eagle, which is, again, also in line with the Manifest Eagle with no drastic changes. So Cognizant's my pick this month.
Okay, so another repeat selection, and certainly nothing wrong with shopping within an existing portfolio. You'll probably hear that as a fairly recurrent theme. Before I close things out, and I'll keep it brief because I want to hear about Vertex and get a chance perhaps to kick an apple around. I did want to point out that we did have a relatively magic moment. I don't think I'm the only one celebrating this. Our Tin Cup model portfolio, which is a demonstration portfolio in our newsletter where we actually have a very transparently open managed portfolio. It's again a demonstration portfolio. It passed the $1 million mark. So we actually had our $1 million moment. It's actually passed it 3 times now because it dipped down below and went back up above, and Kurt likes to hand out ice cream every time that happens. So we've been doing that for the last several days. But to me, and this is a big one, because this is real to me. This is, to me, what this represents is, like a 35 or a 40-year-old person that figures out, can I really still do this? Can I possibly catch up? And if they'd really been putting aside the maximum amount that they could in their 401k since January 1995, it is feasible that this type of thing could happen. And such a powerful demonstration of the principles, because basically this portfolio is managed in precisely the same way that you just heard Cy describe. And I know it's the same way that Ken uses for his personal individual retirement accounts too. So it's not rocket science. It's basically keeping it simple, paying attention to return forecasts, paying attention to quality. Don't get too crazy with things like RIM every once in a while. There's all kinds of lessons to be learned here, because if you actually look at this portfolio, which you can get to from our homepage at any point in time, it's some pretty solid companies. So again, I just think it's worthy of a moment of pause, reflection, and celebration.
Hear, hear.
And with that,
absolutely.
I thought I would point. Go ahead,
celebration. That is celebration material.
Yeah.
Who wants to be a millionaire?
Yeah.
There you go.
And as you know, we've been demonstrating a fund-centered or fund-only version in our newsletter, also with the Horde, and that's just going along swimmingly. We're only a few years into it, but it's just fascinating to see what is still possible, using ETFs and actively managed funds. So more on that to follow. Well, I'm going to close with just one slide, and the slide that I found most interesting to me today was I often will go in and use the stock search function for screening at Manifest, where I'll search on the top percentile based on rank. So I'm shopping instantly amongst the highest, the best potential returns, but not too high. and the highest quality companies. And then I also like to pay attention to the Motley Fool's All-Star consensus, if that's the way you want to think of it. And I like the ones there that they are favorable towards also. In other words, they don't hate my stock. So just entering 99 in both of those two slots, I come up with Ken's selection for today and my selection for today, which is Landauer. Landauer is an environmental company that, as it says right down there at the bottom, that provide technical and analytical services, people, software, and stuff to places like nuclear power plants, physicians' offices, any place where you might see an X-ray, any place where you might use radioactive type materials in construction or testing, that sort of stuff. And again, to determine occupational and environmental radiation exposure. So that's what they do. It's not a really big company, but they seem to be very well managed. I would encourage you to go do your own study, take a deeper look at the company. The ticker symbol as shown here is LDR, Chicago-based company. I've actually dealt with some of their representatives in the past when I called on Commonwealth Edison in Chicago back when it was still Commonwealth Edison. So I've actually seen some of their people at work in a previous life, and everything that I read about the company in recent years is quite favorable. So go ahead and take a look. It is the company that was featured as our cover stock for last month. So in addition to catching up on that $1 million moment for Tin Cup, the other thing that we mentioned here about too much in any one sector, where I answered the question, too much of a good thing. And then last but not least, you've got a couple days left before we switch to the next issue, and there'll be a new company in there instead of Landauer. I just invite you to take a look. So with that, we can leave the floor open to see if there's any questions. Ken, are there any comments or questions that we need to field at this point? Mr. Kavula is muted.
We're getting some questions, Mark, about whether we would consider selling anything out of this portfolio. We didn't present the total dashboard today to show those with very, very low PAR values. But maybe that's something we want to really focus on for our next roundtable.
We certainly can, yes.
There also was a question earlier back when we were looking at the relative return charts, and I don't recall who asked it, but someone had a question about whether you can, yes, I think it was Marie, as I'm scrolling back through the questions, whether you can calculate those return figures for your own stocks and how you would do it. Her exact question is there an easy way? And I guess the answer is yes and no. If for clubs, there is a very easy way, but I know you use a spreadsheet, and I also use a spreadsheet, Mark, but I'll toss that over and let you answer that.
Yeah, I'd be willing to post a vanilla version of this spreadsheet if somebody wants it for calculation purposes. Certainly post it in this, post on the forum. You can build your own. This is a really straightforward spreadsheet. So
Mark, I think the question is focusing on the second last column. Where exactly are you getting the market return number? I think maybe just 30 seconds on that would help.
Okay. The market return is based on taking a look at the total stock market index. We use the Wilshire 5000 or VTMSX, and we're literally just looking at the change in value between the date that you see here, this May 2011, the start date, and the current value for that particular index, and literally just calculating that market return. So between May of 2011 and now, the annualized return on that index is 4.7%. So we're always comparing any investment that we make versus that general benchmark. We want to try to do better than that benchmark.
So that market return number repeats itself. If two companies were picked on the same day, I think the second company was picked on September 21st, 2010. And if you look at the blue band or the green band, depending on whether or not I'm colorblind, you see the very last company was also picked on September 21st, 2010, and you get the exact same return for the index.
Yeah, here's what Hugh's talking about. These two companies, in this case it was Hugh picking Costco, I believe, and up here it's TJX, which was Ken's. And they both have the same market return. That just means the Wilshire 5000 was the same on the start point. And because
you can get all you can get all of this data once Mark posts the spreadsheet with anywhere that you can get historical prices, so you can go back and fill it in for your own portfolio. I use Yahoo Finance, but there are other sources that have it as well.
And we use that extensively also. Does that help, Ken?
Yeah, I think so, Mark. Mark, Ann would like to know, do you have any idea what my par was around June 30th, 07, when the rest, when the red lines on the return graph that you showed were down around 5%? In other words, right before the Great Recession, what was my par running?
9 to 10%-ish, as I recall. Slightly higher than the number you're seeing now for the value line low total return forecast. There were a few other things that worked back then. We were not conditioning quite as much. We weren't collecting quite as much information outside of value line. So the numbers did tend to run a little bit more optimistically back in that time frame. So again, the number is slightly higher than what you see on that particular chart. Ann's referring to this chart. They were slightly higher, but all the ranges were higher also.
Okay, Mark, we have a comment and a question from Mary. Mary says that some Seeking Alpha writers are saying things about Walgreen picking up Rite Aid. Do you know anything about this? I haven't found anything on Walgreen's website, and maybe that's directed at Hugh.
Yeah, there has been talk of various different types of mergers. I mean, Walgreens not beyond buying other companies. It bought drugstore.com, which I thought was a really good addition to its portfolio. It bought Duane Reade, which is really focused in New York. Really good outfit, and I think it's learning something, especially from the grocery side of the business from there. But I've heard rumors, too, that it is kicking the tires of Rite Aid. Now, to what extent that's true, I don't know, but now wouldn't be a bad time to try to do it.
Yeah, I'll add to that, Hugh. Even the latest value line just came out a week ago. The last paragraph speculates about a possible Rite Aid acquisition.
Okay.
Yeah, and in fact, if you look at a stock price, wow, I got that wrong. If you look at a stock price chart on Rite Aid, you can actually see evidence of some arbitrage there. People are kind of looking forward to that. And here you go at the end, as Ken was saying here.
Gotcha,
yeah. Mark, Marie would want to know, does Landauer's debt bother you at all?
Does Landauer's debt bother me at all? Depends on the financial strength. Let's go back and look. It's not in the portfolio yet, so we'll have to go get it.
I think it also depends on the amount of debt that its competitors are holding, too.
Yep. You know, how's the debt compared to the competitors? How is the relative level of the debt? My knee-jerk reaction, without digging any deeper, and we certainly can do that, no. Whatever debt they have, it's not bothering me yet, because the financial strength rating is 98. It's
okay.
It's worth looking at, but I don't have any concerns about it yet. I'd want to dig deeper based on Marie's question, but no.
Mark, we have a couple of people wanting to know where they can access the groundhog listings. Is there an easy place to go on the Manifest site to access the groundhog listings?
Is that coming from Ann because she wants to show off, or is it coming from Hugh because he wants to show off?
Not coming from Ann or
Hugh. Certainly not me. I'd say it's Ann is more likely.
And before we go here, I'm not going to scroll. I refuse to scroll. This is a scroll-free Saturday morning. All right, you just go to the forum, click on the Groundhog Challenge. The second entry here gives you the current scoreboard. If you click on the scoreboard and click on the current year. I'll scroll a little. I won't scroll a lot. All right, so, well, there, Mid-Michigander is right up at the top. You can actually, and a club from Mid-Michigan. I think Hugh is on here.
Oh, yeah, I dropped way down the list.
Oh, you've dropped down, though. He was number 7 last Monday. I know that for a fact. Anyhow, this is how you'd find them. And then if you want to take a look, last year's group champion was the Northern Traders. If you want to see what the Northern Traders...
Chuck Brunel is a member of that club.
Oh, this is disgusting. They're controlling the market. So you can see they've got the age-old favorites there. Let's see what Chuck's invested in. He's edging out his own club by $1. Ah, yes. Some good stuff there. Apples, guns, drugs, wires, and boxes.
Excellent. It sounds like a shooting range on a farm.
I think it would.
Mark, could you do that just once more and show them how you got there?
Okay, we'll go back to the beginning. We'll go back to the Manifest Forum, the general menu. Click on, you have to go down about 10 sections to the Groundhog Challenge. When the Groundhog Challenge comes up, always at the top of this page, you have last year's final results. So if you want to go and admire the results of the Northern Traders, I know they're here today, you can check that out. The second entry is the scoreboard. If you click on that scoreboard, you can look at all of the current entries in this year's contest by clicking on that. And we might as well see Ann won the individual championship, so let's look at our damsel's current settings. And you can see a lot of the stuff that she's talked about and stays true to form. She's basically ahead of the market on almost all 5 out of 5 since Groundhog Day.
Actually, there's not a whole lot of difference between, the top 10 or among the top 10 or even top 15 in terms of the dollar value.
Yeah, this is really tight. I said I would scroll a little. And I'm scrolling a little just to make a point, guys. And let me make this point with the Groundhog. It's something we like to talk about. All of these entries, including some of our honorary guest rhinos like Whitney, I'm scrolling down until I hit the general market. He is above the market. Here it is, right here. Wow. So he is actually still above the Wilshire 5000 since Groundhog Day. And
well, no, I was well below it shortly after Groundhog Day. One of the picks there lost half its value.
Yep.
Well, we have a new expression, Mark. I seem to be pulling a mark on my portfolio, right?
I'm not sure I understand the comment. This is ugly.
Market a good thing.
How far do you have to go down to find my mark?
Are you? You're not on here yet either? No, you're up here, aren't you? I'm not scrolling any further. I can't bear to look. All right.
Maybe you didn't pick mine up, huh? I'm going to hope for that. Okay?
There it is. You're just a little under the market benchmark. You'll notice that I'm still not on the board. It's kind of like Tiger Woods when every once in a while he has a WD, he has to withdraw after like 3 rounds.
You're just letting all the customers win.
No. All right. What else?
Mark, we have a question from Geraldine, and anybody can take it. Is anybody really concerned about all the things going on about the healthcare field as far as Washington and the Supreme Court's concerned right now? Should we be buying our healthcare companies based on concern from what might come out of Washington?
Why don't you go ahead, Hugh, from a macro perspective, or if you want to?
I don't know. It doesn't really bother me. I mean, it's one of the few cases where actually every voter potentially has a skin in the game. So I can't see Washington doing anything incredibly drastic, no matter what the pundits say. When you dig into the details, everything seems to swing to the middle of the road. We'll see. I mean, I know a lot of people are very uncomfortable with the compulsory healthcare mandate, which the Supreme Court will talk about. But for me, at least, there's some very quick fixes to the healthcare system which don't get a lot of attention and don't involve anything too drastic.
I guess I would just point out that I would say be careful. This party, whatever in the party could be wrong, this party's been underway for a while. And if you look at how much and how fast the healthcare sector, this is the healthcare sector, looking at it from the top, things are generally have gotten much more pricey than in recent days. So, I mean, basically what I think is happening is there's a a lot of people believing that the Supreme Court is going to reverse that decision.
Right.
I
By the
think
way,
my biggest feeling about health care, based on at least that question, is I don't know that we're going to see dramatic, certainly long-term shifts in the expectations for the industry,
yeah.
regardless of how the ruling comes out, because this is old news. I mean, we've been batting around the whole healthcare quote uncertainty since 2009, and you can see it in that chart that you just saw. There's been a significant upswing since. I mean, that's when all of this really started. And you know, with the legislation and the debates over the legislation, once the legislation got finalized there in mid-2009, notice you've been steady to up. So, you know, the market doesn't like uncertainty, and if there was true uncertainty, I think we would be in a more potentially treacherous area, or opportunistic. I mean, quite frankly, particularly when it comes to healthcare, I've always liked buying when the uncertainty has been the greatest, because generally what Washington comes up with is never as bad as anticipated.
Exactly.
And I don't see that opportunity right now, because I just don't think even if the Supreme Court throws the whole thing out, it's going to make that drastic a difference. From the company perspective. Now, from the individual perspective, it may make huge differences, but, you know, either good or bad, depending on where you fall in the debate. But I don't look at it either as an opportunity or as a huge caution flag.